All right, Henry, your hand is up.
Madam, please, someone in the waiting room.
Oh, okay. Now it means they are late. All right. Okay. So now, in terms of today, so starting from Wednesday, like I said, we looked at the whole genesis in terms of how microfinance came to be and what gaps it seeks to fill. So, of course, we get to the understanding that microfinance is for a subset of the population, typically referred to as the poor people. So, knowing the poor people, and of course, having learned the basic definitions of what makes a poor person, then we need to understand, of course, the mainstream banking sector has left them behind. And one rule for any business that seeks to be sustainable. And so for you who has also, okay, so yes, at least you remember the assignment, how we can give loans to the poor at an interest rate that does not necessarily kill them as well. And at the same time will not kill the microfinance. Thank you very much. And even as you go through the class, be thinking of an answer for that one because I'll come back and ask. Okay. So now this, so as a microfinance manager, because that's what you're hoping to be, or somebody who will set up one or be a board member when the opportunity allows, is the case where then you need to know your client. In fact, in real business, the difference between the successful business and the unsuccessful one, the successful business is able to identify their clients and provide them services in a manner that allows the clientele to constantly demand the service. So you see, business is providing service to people at a profitable uh, angle. So if something is good, but you don't provide it from a profitable perspective, then it means that you are not in business. So that's what separates business from philanthropy. When you're in business, you seek to provide a service at a profit. You seek to provide a product as a profit. Now, when you don't keep that in mind, then obviously you're doing charity. And so it's clear that for us to be able to give, or should I say, run a business in the microfinance space, we need to be able to estimate demand. Demand meaning those who are likely to have need and able to take up our services. So who are the people? What are the characteristics that define the kind of demand or the way they're going to demand the services? And so when you're looking at a demand for microfinance, that's exactly what you have in mind. Being able to identify the right characteristics that make up for your target market and therefore be able to refine the demand and for that matter provide services that are tailored and also priced to generate some good returns for the investor. Now, at the end of this session, we're going to look at identifying the factors that affect financial service needs of the poor. What it means is that you're seeking to understand and know the needs of your borrower. If you know the needs of your borrower, like I said, it means that you're able to come up with appropriate product design tailored to meet their needs. At the end of the session as well, we'll seek to identify the kind of financial tools that the poor use to manage their money. That way, when you're coming up with a product, you want to be as close as possible to what they normally do, so that in essence, it means that you know them. Then we also want to assess the financial service needs of persons living in poverty. So in all, you realize that it's focused on getting to know the client, because knowing your client in this era, for those who have had a chance to read around, you hear the term being pushed around: customer centric, customer focused, focused product development. For those who have even read a bit further, you hear design thinking. Design thinking puts the client at the heart of the product or service development process, meaning that it is their needs that will actually drive the kind of products you come up with them. So when we get to the end, we should also be able to describe the key characteristics of good quality pro poor financial tools, meaning that when you see a product that is good for the poor, you would know. And then you would be in a position to then roll that out. More often than not, it has been the critic that the kind of products sometimes that are given to the poor are not necessarily pro-poor. It's just the same standard banking services and products that have just been re-engineered to give to the poor. So it doesn't really, it's not cut out for them. So that's the whole idea: understanding the needs of the poor and therefore being able to carve out the kind of demand that they will be able to place on us. And of course, you're going to look at why the poor might benefit from financial services if they were more readily available. And then this will be more of an assignment. So I'll be taking a lot more assignments from you, given that we are mostly virtual. You hand in a number of assignments. Bear in mind that you are not to plagiarize and send to me, because I will find out. Now, we're going to propose ways to improve financial services to the poor. Because if you remember the bottom of the pyramid assessment, what it means is that the chunk, more than half of the typical population, is at the bottom of the pyramid. So we need to come up with the right services and products to meet their needs, so that together we can all grow. And that is what we call sustainable development, capturing everybody and then not leaving costs as well behind. Now, when it comes to the poor, their borrowing and savings patterns will change. In fact, even within categories like those who do agricultural day laboring, their savings and borrowing patterns are different, because they have a time to sow and then a time to reap. They sow and they reap seasonally. So their borrowing and savings will usually follow those kinds of patterns. Then we also have the farmer. So the day laboring guy collects maybe during the time that they have to sow, some weeding time, they get some money. And then the harvesting time, they get some money. Then the farmer has a different pattern, mostly borrowing at the beginning all the way through to harvest, and then they make their money at harvest time. Then we have a small shop or workshop owner in an urban slum. Then we also have the low paid wage worker in a factory, domestic servant, truck pusher, office cleaner, street vendor. What we're trying to say is that when it comes to the poor, there are differences in how they borrow and save. So one of the easiest ways to be able to ascertain demand will be to know the kind of patterns they have for both borrowing and savings. And that is what will begin to influence the kind of product design that you would have. So for this class as well, I want you to read briefly on design thinking and see how that can be used in the development of financial services and products for the poor. The concept of design thinking. So I expect you to read on design thinking and then see how the framework, the design thinking framework, can be used to come up with appropriate products for the poor. Now, when you look at, so clearly the savings patterns will change depending on the kind of work they do, even in that same informal sector. Now, there are other things that also affect their demand for services. And in a case, is the composition of a household. So sometimes the age that you find for, let's say, in this case, I'm going to use a proxy, the one who is in charge of the household. So it could be a household headed by a woman, or it's a household headed by a man. So the household head, so it could be your father, your mother, or both of them combined. Their composition will determine the kind of services they are likely to demand. So most likely you look at the age. We've done a study, so I'm going to possibly see if I can get a draft available for you to look at. But then it looks at the household level and the kind of factors that will influence the household head to demand. So in some cases, when you're working and fresh from school and working in your prior working life, you are likely to save a bit more in the mid-range before there's a time that you like to spend some more. So you most likely will be taking out loans and whatnot. And then when you're getting closer to retirement, you will have input done as much of the spending as you can. So you save some more. And then your demand for certain financial services will also change. So those are the household elements. Now, gender in and of itself also has an implication for the kind of services and products that will be demanded by the target market. More often than not, if you have women, sometimes their risk-averse nature will mean that they are more likely to want to save as opposed to taking out loans. The men usually would like to take out more loans than they are able to save. So where you have a target group that possibly has more women, then maybe your product development may be skewed more towards saving incentive-based deals for the purposes of saving, and for the men, then you would have something different. So gender in and of itself shows that there are differences between the genders. There are differences in how they demand financial services and even how they use them. Then there are also personality issues where some people are a bit more cautious than others, and some may be averse to loans and ready to save, and others are not averse to loans at all. They can borrow and borrow till they sink beneath the weight of the debt. Now, when it comes to culture, the culture of a particular locality or a place will likely influence the behavior of the whole group of people. So sometimes the preferences they have will be shaped by the culture within that setting. Now, also, the degree of monetization of the economy affects the scope of financial intermediation. So you see, if you happen to want to open a rural bank in a community where they do a lot of barter trading so that money does not exchange hands, then you're likely to have a bit of a challenge getting them to warm up to the idea of being financially included and making savings or using financial services. Then obviously the life cycle that a group finds itself in also plays a big role in the kind of financial services they demand. So in essence, the pattern that life takes them through will determine the financial needs that they're going to have over time. Now, when it comes to needing, so now that you know that the patterns change and other things affect that, another thing you want to know is the intrinsic motivation for the need for financial services. Now, when it comes to money management, there is a bit of research on the complexity of money management among the poor. They are unique sets in and of themselves, worthy of being studied differently. So when it comes to money management among the poor, there are quite a number of challenges. One, their cash flow patterns are a bit awkward, and so they tend to need consumption smoothing. I'll come to speak to the issue of consumption smoothing. And then also how they deal with emergencies or risk management is also another way that makes the poor different. So that when you have to come up with financial products or services for them, you need to keep these in mind. Now, in general, the poor struggle to assemble large sums of money to take care of major life cycle investments or acquire small businesses for self-employment. So in general, you realize that they actually need financial services and products because of these. And so knowing also that their day-to-day management, money management is quite an intensive part of their day-to-day life is key. Is key in coming up with the right products and services. So normally they borrow and lend close by in their slums or villages. So there's this closed community. So sometimes they can use money guards. Money guards, people they leave monies with, some have protects for them because they don't want to. So someone like almost like a storekeeper. But money guards are unreliable, hence the poor end up borrowing or buying goods on credit or going into arrears. So now that's the challenge as to why they do what income smoothing. Now, income smoothing in and of itself can be looked at from this angle. So you see, because the poor usually have erratic cash flow, meaning that their cash flow is not consistent and the pattern is not something you can predict, then what it means is that you have a case where they need to smooth their income. So it's like they need to spread it out in a fashion that will allow them to maintain a certain pattern of spending. And that's typically income smoothing, meaning that you're trying to smoothen the pattern of income. So there are quite a number of ways that they do that. Now, when it comes to the poor, another thing that you've come to notice is the fact that they are seriously prone to risky situations. They are prone to risky situations, very risky situations. And then they proceed to the point of sometimes they live, sorry, I'll move the slide ahead. They live close to, okay, hold on for me for 2 seconds. Okay, so we realize that the poor are usually close to places that are likely, in fact, it's as if everything is against them when it comes to being poor. They are closer to rivers that flood, farmlands that are prone to drought. They live in slums with uncertain legal status where they can easily be affected by landlords, governments at short notice, or suffer from fires. We all hear of the fires that hit at the bush in the markets and the way it goes and ravages and goes on through the slums. Now, when disaster strikes, they may have to sell their assets or pawn them. And their social networks are usually what they fall upon for gifts and anything that can help them to get by. So, interest free loans or low cost loans. Now, even in some cases, to manage their risk, they join uh, informal burial societies, which will ensure that in the event that they die, they are buried well. Oh, okay, thank you. So Sodom and Gomorrah, so we know. And we always hear how the fire just takes them out, and then once they take them out, it becomes a bit of a challenge. Now, when they have to build for bigger sums, which can arise from certain big events like festivals, marriage, etc., they usually find themselves wanting because they don't have what it takes. So the question has always been, at one point in time, you always need some money to get by to, you know, pursue life's bigger events, set up businesses. So what they normally do then is that sometimes they migrate to find work in the big cities, and sometimes they'll need to even finance these often costly journeys. So when it comes to building these bigger sums, the poor are usually quite disadvantaged, and that's actually part of the reason why you need to understand them well, know them to be able to arrive at the appropriate uh, products and services that you should give to them. Now, when it comes to building bigger sums, sometimes instead of banking, they are likely to buy jewelry, they invest in roofing sheets, livestock, etc. That's what they use as their store of value. You normally don't find them doing a lot of banking. Now, they also sometimes use what we call ROSCAs. These are rotating savings and credit associations. Now, the typical ROSCAs is that a group of persons will come together and then decide that we are all going to contribute because we don't have money and maybe we don't have a bank. What really then happens is that we are all going to contribute a certain amount of money, which then goes to Ama, who is maybe a member of the group. So we are about 10. Now, when that happens, what it does for them is the fact that at any point in time, they are able to raise some big amounts that they can use for the, hold on, a moment. Let me disable the meeting room. A number of you keep on dropping back and forth. And it's, so hold on, let me try and disable the meeting room. All right. So these ROSCAs, they are just rotating savings and credit associations. So what it means that you can find, let's say, a group of 5 or 10 people. They come together and then they have a fixed period. It could be a month or monthly basis or weekly basis, however it works for them. And then week one, we are all going to contribute for AMA, including Amma herself contributing. So if there are 10 of us and we are all contributing 50 cedis, it means that at the end of the month, Amma is able to raise 500 cedis to go, or the end of the period in question, Amma can raise 500 cedis to go and trade whatever. This is something Amma ordinarily wouldn't be able to do unless Amma has to save for 10 months. Then, and of course, saving for 10 months, we know the number of things that can happen within 10 months, even including whatever it is that Amma had in mind to purchase, the price changing, or other emergencies happening within that time that does not allow Amma to ever get to her 500. But instantaneously, Amma receives, let's say, 500 cedis from the association to go do something. Then the following period, whether it's on weekly or monthly basis, the next one goes to Ajwa, and then the next one goes to Mensima, and then Sewa, and then it goes on, and it goes all round until everybody gets, and then it starts all over again. Now, the challenge is that in some cases, integrity becomes an issue where some people collect and then they disappear from the group. So that's now it's not also every self-employed person who wants to join a dedicated ROSCA for reasons to do with the financial facts of his or her life. They are not sure about the consistency of their cash flow, so they are not too sure they want to join. And when it's time to make good on payments for somebody, then they find out that they are not in a position to do that. And sometimes the pressure to keep up with the payment schedule can be that severe. So knowing your own facts of life. Is somebody talking to me? Yes. I would want all mics to mute. And if you want to talk, you use the raise hand icon and then I'll call you to speak, or you type in the chat box and I see. Now, pressure to keep up with such payment schedules can really be a problem. So even for these opportunities for raising bigger sums, sometimes it can be a challenge to keep up with. So it means that you don't raise the money at your own pace all the time. And that can even be another challenge. Now, when it comes to the financial tools we've seen so far for the poor, they may be convenient. It may allow for the frequency you want. Sometimes it's also flexible, but it isn't always reliable. So you realize that in terms of convenience, one of the most convenient tools of money is that if it's convenient, then you should be able to organize it. The users themselves should be able to organize themselves for it. It doesn't necessarily need to interact with others. It doesn't need travel. It's available any time of day or night, and it's at little or no cost. So those are some of the most convenient tools that, when it comes to convenience of the tools, these are the things that define it. Now, some also decide to have financial diaries, or the financial diary research found almost every poor household held or tried to hold savings at home, which we all know is usually not too safe in every sense of the word, from theft to you yourself using it because it's so easily available and not so out of reach. But then you see, because of this convenience that is so good for them, it also poses a problem in terms of drawbacks. So then it becomes a challenge. Now, when it comes to money lenders as an avenue, thank you. So a money box. Yeah, thank you, Patience. So yes, people use the money box at home. We all have heard of cases where Sodom and Gomorrah has burnt down and then people now start crying about their monies that were in some boxes, or in some cases, some even had dug to the ground somewhere and put it. And now that the whole place has been raised to the ground, they are unable to indicate which points of the land space actually has their money. Now, when it comes to using money lenders to raise the amounts of funds they need to undertake their big events, money lenders pose the threat of very high interest rates, which then makes the money being made of it too expensive. So then it becomes a case that MFIs become the midpoint. They operate almost like banks to provide the security and reliability of banks, but also to approximate the convenience of informal finance, as we see from the savings at home, save as and when you want to, when you feel like it. Sometimes you don't even have to go to the bank. The microfinance institution will come to you at the marketplace, etc. And then all the entries are done in your passbook. So typically for the tools that the poor use, normally the convenience is good, flexibility is afforded sometimes, but reliability sometimes can be a problem, and also the possibility of risk. Now, when it comes to discipline, saving on your own can be hard. Saving with a money guard helps to impose some distance, but not enough discipline. So these money guards are people who may live a bit away from you, that keep the money so that it's not like you have easy access. Group savings like Roscas offer much more discipline because you're relying on group pressure and sanctions to keep the transaction flowing regularly. But Roscas can fail, which I've already mentioned. Sometimes one person takes the money and then they leave. And so the integrity aspect of it is. So now when it comes to really big sums, however, enough to buy a home or set up a business sometimes, usually cannot be accessed through these Roscas and informal avenues. And that is where you realize that there's a limitation to the goodness of the financial tools being used by the poor. So then the question is, we need to provide them with these services. Now, in all of this, you realize that there are social angles to the kind of tools that the poor use in raising capital. So there's always a social embeddedness, meaning that is bonds within the society or the community that they use to fashion out. The money guards are more of persons. You say that in a raw sense of the word, the money guard sometimes can work like susu collector, but usually the money guard is somebody you trust that you go and leave the money with to save it for you. So it's not the typical commercial susu collector who is doing it more for a commercial purpose. But the money guard is more of somebody that you trust and for the purposes of keeping your money safe for you. So that's the issue in terms of money guards. So as for the susu collector, they go around and they are collecting the susu, but the money guard is somebody you give the money to who somehow guards it for you. So it's not a commercial oriented susu person that we know about. You get it? So that's the typical concept of the money guard. The person is guarding your money for you. It's not just a pure susu collector. Yes. Now, we realize that when it comes to the discipline that Roscas offers, it comes from social bonds, the relationships that they have. That is what usually holds them together. But this discipline is often tempered by flexibility in the way in which the Rosca responds to clients' needs. So yes, there's some flexibility And then for those who are able to manage negotiability successfully, they offer flexibility and responsiveness. So it's not all persons who are able to tap into these rosters or avenues that are used by the poor, because for them, the poorest people typically are less able to engage maybe on the roster level. So you realize that it still leaves out some people. And so by leaving out certain people, what you do is okay, can we then create better financial services for the poor? So you see that obviously there's a gap in there. The people try to fill it in, but then they fall behind. They are not able to do it all. And so they, okay, thank you, Patience. Patience is being a contributor, but it looks like she collect all the scores for participation. And then Isaac is also saying, yeah, employer or superiors, yes. So somebody you trust and respect. So you don't just walk into their house every day that you want the money. Thank you for those. Now, so when you look at all of these, you realize that there's a need to create a better set of financial services for the poor because the informal and loose nature of the tools and services they employ. Now, who is disturbing my class? Now, the informal tools they employ to deal with their challenges, both in terms of risk and etc., makes it very unreliable. So taken together, this suggests that microfinance is really something that is big in terms of opportunity to grow in both quality and quantity. Because if you look back, you realize that if you've got more than half of the population being poor, and they don't really have services and products to meet their financial needs, then obviously there's an opportunity in there. And so at the heart of it is how to take advantage of these opportunities to provide services, financial services for the poor, and at the same time, make sure that it is profitable. So of course, we know that there's very high demand from the poor people for financial services. And then secondly, it means that it has not been met, neither in volume or in quality, so that there's an opportunity at any point in time to offer those services. Third, a great deal of the demand from the poor is not for the services that the microfinance industry has currently emphasized. So, what you can see is that yes, the microfinance institutions are trying, but it appears that they haven't yet scratched the surface. So, and then we all know that the methodology that the microfinance institutions have developed will be relevant to meeting this demand. The question is, how do we improve and extend these products and service delivery systems? And more in general, there's a suggestion that the demand by the poor people for financial services may be quite similar across regions and districts. So it means that the poor actually offers a very large market for microfinance to be successful. The question is how we tap into it. So even as we go through this course, you may want to keep at the back of your mind, if I do come to you, and I'm likely to come to you and ask you that, let's say I'm an investor, I have money and I want to set up a microfinance institution in a particular locality. It may not be Accra, but it could still be Accra or any of the regional centers. Are you able to estimate the potential demand for that segment and give me all the market dynamics that will ensure that should I set up the microfinance institution, I'm hopefully going to run at a profit and not a loss? Meaning that there's a need to know the people who are there, their characteristics, what makes them different, and how, therefore, we can tailor the services to harness the differences that they have or the uniqueness that they have to bring it out there and make it a profitable venture. Now, when it comes to formal service providers like the typical banks, one of the biggest struggles they have is getting close to the poor. So a key challenge for them is the struggle to get close to the poor to compete with the proximity and frequency of informal tools. So you see, when it comes to money lenders, you can go to the person in the morning and by afternoon the loan is ready. But when it comes to formal institutions, they have to do a lot of due diligence before they give you. And if you remember, until UT had challenges, they used to say that what a loan in less than 48 hours. You realize they were trying to meet that swiftness that comes from the informal sector, but then using a banking framework. Because in general, the typical bank would not approve a loan sometimes under 1 week or 2 weeks. No, they're going to do a lot of due diligence back and forth. It takes a bit of time. So that's one of the challenges that formal banks face when it comes to, meeting the poor by virtue of closeness of service and going to maybe mount a bank in functioning corp and then also give a loan out in about 48 hours or 24 hours. But by finding ways to encounter their clients, formal services should be able to gain a much bigger share of the everyday financial intermediation of the poor. And that's true. So you see, now we know that these people have informal tools. Question then is, if we are able to make inroads into that space and understand them fully, then even then there's a bigger market share out there for the taking. So when you are contacting them, then it means you need to know where they are in the village or slum, and doing so as often as you can, and through regular weekly or daily routines or via cell phones and bank agents. So it means that you need to find ways of also being a frequent collector like their neighborhood money lender operates, because this money lender will get up maybe almost every afternoon and go to all the people who owe them. Now, the typical formal bank expects you to come in and pay, but that does not work when it comes to the microfinance, the clientele for the microfinance. So you need to now think of ways and means. And so, of course, the advent of Momo has been a way to sometimes reach a number of them where they take the loans and still make good on the payments. And then the salespeople come around to collect and then make the necessary recordings in their books and also transmit same to the bank's records. Now, another challenge for formal providers is the flexibility. So like I said, today you need 20 cedis, tomorrow you change your mind, it's 50. So now the question is, how can they adjust better to the irregular cash flow patterns of poor clients? That's another thing. So even when you give them a loan, how do you adjust to the fact that they are not formal and working in formal institutions to be paying you the regular amounts that you know and need, but rather they pay you as and when they get it. So then the question is, how do you factor that in? So that's a challenge for most formal providers, which they have to navigate. Now, because I see a question or a comment. Okay, the lender, as expected, chases their money. Yeah, so when it comes to the bank, sometimes they may be the lenders, and the agents who are supposed to work for them don't always work with the bank's best interests at heart. We've had cases where agents sometimes even go and collect the money and then they pocket them and they themselves disappear. Oh, okay. So Ruth is telling us that yes, when it comes to this area, the rural banks are doing quite well to assist the rural folk by way of convenience and even speaking the native language to aid the poor in banking. Yes. So yes, if you look at Ghana in general, I think if you ask me, we are better off with a lot more of the rural banks and the MFIs and very few of the large formal banks, because majority of the population is falling in a bracket that can easily be served by rural banks. And so, of course, the numbers will also help to keep them profitable. Now, formal commitment saving plans for the area of microfinance is a big deal, because then it allows them to sometimes get things like what insurance and pension. It's an area that is worth exploring. And then when it comes to the banking institutions trying to get in, they offer the discipline that the poor find in devices such as Roskes, but also have add value by having longer terms, allowing for larger sums to be formed. So that's the beauty of services that can tailor for the poor, in the sense that it needs to meet their need for flexibility, proximity, and the social embeddedness. So as a rural bank or as a microfinance or any entity serving the poor, you must be social, means that you're close. In a sense, in fact, in one or two documentaries I've watched, because I was actually trying to probe how we can better microfinance in Ghana, realize that in some of the countries, in fact, when they go to the bank, they are also treated like somebodies. You know, sometimes the reason the poor struggle to walk into a banking hall is that they are seen as poor, and so they are treated as such, poor people. But they also have feelings and they have emotions. And so when you begin to treat them as somebodies, it works to the advantage of the institution that treats them like they are also what, persons. So of course, it comes to the issue of wanting to belong and then wanting to be acknowledged at their, within the appropriate circles. Now, so when you look at it, then you realize that there is obviously a future for financial services for the poor. So, what does the future really hold for the poor in terms of financial services? We need to have at least a minimum menu of financial services for all poor clients in the second decade of the 21st century. And these should include at least some passbook savings, flexible small scale loans. So these are short to medium term money management arrangements. Then you can also have medium term loans, which can run up to, let's say, 3 years, with structured repayments suited to whatever is known about the household's client, the client household's cash flow. So you can see that consistently the difference between microfinance and what we'll call the formal banking sector is this connectivity between the people. You know them, and so your financial products are tailored to their needs, as the case may be. In the typical banking sector, this is what we have. You either take it or you walk. And so those are some of the issues. But when it comes to the microfinance sector, you need to tailor to the needs and desires. So you need to understand their borrowing needs, their savings needs, and then you come up with a financial product to suit that need in particular. Now, there's also the need to start providing insurance. So can can people be muting up? It really disturbs me. Now, insurance can start with the basic risk that you can easily quantify. So life insurance, uh, uh, you can also take maybe property insurance, etc. But more importantly, start aiming towards the difficult ones like health and agriculture, because that's where, for a chunk of them, that is where their livelihood comes in. So it's like some kind of insurance that protects their livelihood, because that is what will make them not run down into downright poverty in the event of what? Some mishap. Because you know, insurance seeks to indemnify you, to restore you to your original position before an accident or a disaster. So given that even the poor have majority of their life within their Greek space, that is still a very delicate area that is being explored. We haven't yet fully managed it, but we're still going on and on. And then we also need to make room to offer long-term loans to carefully selected segments of clients. So that's an area that we can look at in terms of the future. So having a minimum menu of financial services made up of savings, short-term loans, long-term loans, medium-term loans, provide them with insurance, starting with what is easiest and then moving on to something that is a bit more delicate like agric, etc. And then go on to longer term facilities. Okay, so somebody's asking whether major banks providing small loans via Momo platforms, is that also microfinance? In a sense, yes, a number of them are now, what really makes for microfinance is this group of persons who are so unique in their characteristics that you have to get like a desk for them. So yes, we have group member collateral and property collateral. Yes, those are avenues that are used to mitigate the risk factors within the microfinance space. We'll come to understand all the details in full. So in general, yes, a number of formal banks now are beginning to come up with microfinance desks so that they can also manage a few people within their space. Now, in general, for this lesson, these are the typical issues in terms of the demand. So it comes back to the issue of to be able to design the appropriate product, you need to know who they are and how they go about their money management in general. Only then would you be able to come up with products that suit or fit the segment that you're looking at. So as much as possible, you need to know the kind of questions you need to ask to be able to identify the right characteristics that will help you to come up with the right product. So if you go into, let's say, the microfinance space and you happen to be a microfinance manager, etc., and then you have to now decide what products you should bring out there, you need to know that you cannot just go on and then sit in your room somewhere and decide that, oh, okay, this one should work for the poor, and then you come up with those. So that's for the demand side. Now, let's continue to look at the issue of financial inclusion. Now, we can see right from the word go that the poor are usually excluded from the financial sector. So when they are excluded, they are excluded usually because the services are not affordable. They are not the kinds of services they want or need, and they are not the kind of services they can tackle. So they end up being excluded. Now, we all know the implications of financial exclusion in the sense that if you don't have, let's say, access to insurance and then disaster strikes, you're going to then sink even lower into the poverty well. So financial inclusion has become a very topical issue in recent times because a number of studies have proven that when you manage to include the poor in within the financial services space, meaning that you are able to provide affordable services, so you're able to give them access to services. They are also able to use the services you're providing, and they genuinely can afford the services. It really transforms their lives. So financial inclusion has become a very topical issue because it's been linked to sustainable development and growth. So at the end of looking through the financial inclusion lens, we should be able to explain, if I were to give you a short write-up to make a case why financial inclusion is a global priority, I expect that you should be in a position to write at least a 2-pager or a 3-pager on why financial inclusion is a global development priority. Then you should also be able to discuss the role of government in promoting financial inclusion. Explain the value of measuring financial inclusion. Look at the tools that we use to measure and monitor financial inclusion and to be able to conduct some basic research on financial inclusion. And then also explain the purpose or the demand side and supply side research in the area of financial inclusion. We have a study that we've conducted currently and seeking to publish that actually looks at both the demand and the supply side of financial inclusion, finding out what actually will cause people to either demand more or less of financial services, and what will also cause the financial institutions to provide more or less services for the purposes of including the poor. And so it is a very topical area, so you'd want to read around. I'll see if I can get you 1 or 2 articles that you may want to spend some time reading on. Now, when it comes to financial inclusion, you take out the 2 words, financial and inclusion. So inclusion means being roped into a particular space, and that space is the financial services space. So financial inclusion refers to people and businesses having access to appropriate and affordable financial services. So what it means is that it could be the case that there are financial services and products, but they may not be appropriate. So it is when it is appropriate and affordable, then we say that these people have been included. Now, we can also look at it as making a country's financial system work better for the poor. So making the financial system work for the poor is usually another angle for financial inclusion. Usually it means that both public and private players must come together. No one person can provide it in totality. So the 2 parties, public and private players, must come together. Now, financial inclusion is not just simply about the numbers, like getting more people into the sector, but more importantly, it is to ensure that they have access, they are safe, and then there's also financial capability. So the whole thing is about the fact that the services that are provided for them do not necessarily end up exploiting them in the long run. Now, in as much as there's a lot to say about how important financial inclusion is, because you see, when you are included, and then let's say, I gave the example the last time that let's say you meet somebody who sells cocoa by the wayside, and then you are able to give them a loan of maybe just 200 cedis or 100 cedis. They are able to sometimes transform their lives. And so financial inclusion, that is making sure that we get funding and services to the poor, is linked to economic growth and poverty alleviation and etc., reducing the income inequality gaps, etc. So policymakers in general recognize that when you do foster financial inclusion, or what we say inclusive financial services, meaning that financial services that also reach out to the poor, there are some barriers, which of course we've indicated earlier, but we're just going to rehash. The supply side, for financial inclusion, somebody must provide the services. That's the supplier. So they sometimes have transaction cost issues, meaning that the cost of transaction can actually be a challenge. Sometimes they lack the relevant information and or the know-how to serve poorer customers. So that becomes a challenge that stops them from providing the services. So when it comes to the people who provide the loans, like the financial institutions, they normally have a challenge with the cost of providing the services. and then inadequate knowledge and then information. On the demand side, meaning those who actually need to demand for the services, sometimes socioeconomic and cultural factors can be a problem in the sense that in some cultures, maybe women are not allowed to borrow. So if women make up the majority of the household heads, it means that they cannot access credit, and that means that they'll continue to live in poverty. Then also the issue of lack of formal identification systems and low levels of financial literacy. All of these play a role in making the people who are to even demand the services, it becomes an obstacle to effective demand, as you'd put it. Now, when we move on further, another challenge to financial inclusion is the poor regulatory frameworks that we have. We usually have challenges where you realize that the financial, the regulatory space is challenged in a number of ways. In a number of ways that take away the confidence for sometimes the suppliers to also, uh, you know, make the funds available. So consumer protection mechanisms that sometimes hinder the quantity and quality of financial products and services. So all these play a role in terms of blocking or making financial inclusion a much harder nut to crack. So that's for the challenge when it comes to seeking to have financial inclusion. Now, so someone said, then what do we do? There's a role for government to start with. So government is the rule maker, and they are supposed to help create the conducive environment. So there's a need to determine ways of promoting financial inclusion, by whom, the how, and when. So government is responsible for creating the rules for prudential regulation and consumer protection. Now, once they create appropriate rules and ensure that these are appropriately enforced, then the environment becomes safe for those who have capital that they would want to use or employ for the purposes of providing services for the poor and enhancing financial inclusion. Now, failure to provide this environment means that the investors or the providers of capital do not feel safe. And once somebody doesn't feel safe, they will not be willing to risk their capital. So people only would take calculated risks, especially when they have some assurance that this calculated risk is worth it. Now, there's also the need for government to enable innovative financial inclusion models, including the entry of new actors into the sector. So, some time back, money lending was not necessarily recognized, but then now we have found a way to formalize that in a sense. So the microcredit aspect is a formalized way of doing the money lending, and then also find ways of fusing different systems together to ensure that the poor are also catered for. Now, another key thing that government must do to be able to foster financial inclusion is to maintain a stable economic environment. And also, back to the issue, aside from creating the rules of engagement, the frameworks for supervision and regulation should be very clear. Now, when this happens and there's macroeconomic stability, it means that I know that, oh, when I do A, I'm going to get B, and out of that B, I can get C. That way, I can make decisions and take risks as well. Where there's instability, people begin to speculate. So if you take, for example, when the dollar and CD rates are misbehaving, you find people hoarding dollars. And what it does is to even worsen the economic situation. But where you are assured of macroeconomic stability together with stability of the cedi, for example, then you have no need to go and convert your cedis into dollars and then suddenly make the dollar currency a scarce commodity on the market, which then goes back to also affect the strength of our currency, and then it becomes a vicious cycle. Now, government also has a duty to provide systems for the delivery of financial inclusion. So in essence, providing service delivery infrastructure. So one, as a provider, a regulator or promoter of infrastructure. So they either provide it directly, they provide the regulatory environment and end up promoting other people to get into the space. In fact, when you read articles and books on the role of government within the pursuit of economic growth and development, the story is quite interesting from majority who believe that government's role is just to create an enabling environment so that the private sector players can then take up the job, because when it comes to private sector players, they are able to adequately measure the viability, because government in general does not go into business for the profit inherent. It goes in for typical welfare scenarios. So as much as possible, financial infrastructure should be provided. And sometimes this can be even post office, ATMs, POS devices, automated clearinghouses, real-time gross settlement system. So in essence, providing the payment systems as much as possible. The payment systems that will facilitate people taking up financial services or making use of financial products. Now, they also need to provide support services. So aside from providing the infrastructure or the chain that allows people to move money across the system, they must also provide a supportive framework. Now, some of these supportive frameworks can be looked at, let's say a credit bureau. Currently, there are about 2 or 3 credit bureaus in Ghana. Before then, there wasn't. Now, these credit bureaus, what they do, I'm sure you've heard of that mostly outside, and now they do credits. They have data on people's credit worthiness. And so when an institution wants to lend to you, they visit these credit bureaus and they are able to tell whether or not you are worthy for loan purposes. Now, deposit insurance is also another thing that is coming up these days and is becoming and a very core aspect of the financial systems for a lot. Even in developed countries, they have it. Now, deposit insurance is a more of a framework that allows the central bank to step in. Of course, having ensured that the banks take up insurance policies that protects the deposits that customers have come to place with them. Now, what this does is to provide assurance to the depositors that in the event of a bank failing, at least a certain minimum amount or even the full amount of their deposits will be paid back. Now, with that kind of confidence and assurance, you'd find that entities within a particular economy are then going to feel more comfortable putting money in the banks, etc., because they know that even in the event of a disaster, they will get some or most of their money back. Then also there's the issue of a collateral registry, which is a recent one that is being pushed forcefully in Ghana here. And these are all support services in the sense that it facilitates financial service delivery or product. Now, let me give you a case of this collateral registry. There have been cases where somebody has a car and then has gone to use the same car to take a loan from Bank A, Bank B. In fact, this same car has been used as collateral to take loans from so many banks. And then the person finally defaults, only for one bank to realize that another bank has already taken over that car and is literally selling it. So this collateral registry then requires that for the purposes of using any such facility as a collateral, you will register it fully at this registry. So that if you go to Bank B and you want to take a loan and you bring this very car, they can check the collateral registry to be sure that this collateral is clean. It belongs to you as you say it is. You have not used it as a security for another loan facility, etc., etc. You haven't even sold it. So all these things, once provided, make for a more safe and secure environment for the provision of financial services in general. And when that happens, even the poor will benefit. Okay, I see a chat. Let me see. Okay. So yeah, Fidelity paying, but yes. So that one, they haven't yet done the deposit. So this one is state funds that are being used to pay. So it's more of a directive with the government. But when it comes to deposit insurance, then insurance has actually been taken out so that it becomes part of the bank's cost of doing business, which they will factor into their pricing for services. Meaning that even as you go to the bank and deposit funds, the bank will go and take insurance on the deposits you have brought. So in the event that something happens to the bank, the insurance cover is triggered, and then it is an insurance firm that will now make good on the lost deposits. So those are for, yeah. So currently we don't have a very formalized deposit insurance system. We are now leveraging on the taxpayers' funds. But I want to get to a more formal structure where it is actually deposit insurance and then see how that rolls out. Then we also have non-financial infrastructure, because in essence, they all provide for making financial services a reality for the poor. Provision of roads, for example, will allow certain financial institutions to access those areas for the purposes of being setting up bank branches, etc. There should be electricity, because then they will need to tap onto the grid for their machinery and whatnot. Then appropriate national identification systems. At this point, we are still trying to find our way, and now I think the latest one is to use the Ghana card for everything. So we pray that that stays. But in times past, you find people from health insurance card to the driver's license to voter's ID card. There were just so many cards. And even sometimes on the same card, somebody is called Sewa Akoto Yebwa. Then in another card, the person is called Sewa Yebwa. Then on another card, the person is called Sewa Yebwa Akoto. It's just a complete chaotic framework. So having proper national identification systems that can even begin to triangulate from where you live, where you work, and up-to-date systems will go a long way in creating the right kind of environment for the provision of financial services that would also reach the poor. Also, the need for appropriate communication systems so that, of course, we can employ the internet and the whatnots in the provision of what? Financial services. Now, government also has a role of promoting savings through whatever kinds of payments they make. So in some cases, they promote savings and inclusion by doing social transfers and sometimes passing wages and pension payments onto electronic channels. That, in a sense, the whole idea is to get them to or get people to be included in the financial services space. And so whenever government uses channels to move ordinarily excluded persons into the financial services space, that's actually a way of promoting financial inclusion.
4:30, Papa. I cannot Papa guy attendance.
Can you stop talking in my class, please? I know you end at 4:30, but please don't disturb my class. And all of you, keep in mind to mute. The next time I find somebody's mic disturbing my class, I'll remove you from my classroom. Now, because I'm recording this video, and then when you have these mishaps, then it doesn't make for a very fluent one, which I'm not too keen on sharing. Now, when you move on to accessibility, so what they try to do is so government will promote savings by making sure that a lot of payments go through the financial system as much as possible. So that's a way. So whenever government also pushes to make payments electronic, what it does is to roll persons into the financial system, and then also there are less leakages. Now, of course, leakages become a cost to the nation in general. In some places, the use of electronic payment portion, like what we tried here, e-switch and the rest, could play a role in enhancing financial inclusion. And so that's how government can also still play a role by promoting the savings through whatever kind of payments that they make to the population. Now, the role of government also stretches to the issue of consumer protection. Now, the poor, so you realize that one of the reasons the government will step in to pay depositors like DKM, etc., is to protect the consumer. Now, because the poor usually have low levels of financial literacy and capability, and also have very little experience with formal finance, government has a responsibility to ensure that these consumers are adequately protected. And so consumer protection is one of the key elements as far as the role of government in the promotion of financial inclusion, so that we have effective consumer protection via regulation, so that one, there's healthy competition leading to improved products and services. Now, healthy competition can take a number of ways. Look at the case where one bank says that, oh, they're giving 10% interest on deposits. Now, by virtue of the little experience that maybe a particular community may have with formal finance and their low levels of financial literacy, 10% monthly interest looks very lucrative. And so suddenly they calculate and realize that, oh, this is 120% or whatever small money I can put there. Now, that becomes a bait and they end up putting money. But 120% is not realistic, neither is it sustainable for any entity. So that by putting in place appropriate rules and mechanisms to protect the consumer, government plays a role by making them feel safe to be able to play within the financial services space. And then the consultative group of to assist the poor suggests that consumer protection pursues transparency. So it means that the providers of the services and even the demanders of the services, there should be transparency, there should be fair treatment, and effective recourse. Recourse meaning that an opportunity to take action in the event that things don't go in the manner as is reasonably expected. So that if, let's say, DKM has collapsed, what are the avenues for redemption? So those are the elements or the roles that government can play in fostering financial inclusion. Now, another role they can do or they can play in fostering financial inclusion is building financial capability. Now, one of the key financial capability is being capable of making the right decisions in the right frame. And that's one of the principal consumer protection strategies, because you see, when you are financially capable, your decision making and whatnot is also usually at its best or at the peak. So consumers need to understand the product choices and the right to choose the services that are best fit for them. So you see, when your financial capability, meaning your literacy level, typically has been improved, and then your educational level, and then even your capability to earn and invest rightly, then that becomes an avenue that also encourages and enhances financial inclusion. So in terms of the role of government, there are so many ways. And like you see, most of the issues are geared towards creating an enabling environment, or an environment that fosters confidence within the financial services space, so that consumers can take up financial products. Now, I'm going to end this here for today and then open the floor for questions. Okay, so patience, yes, I have. So for those of you who have not read that particular public circular, you may want to go and read the circular from the BOG, which served notice to remove certain illegal payments and overcharges and etc. Yes, it is to enhance financial inclusion, because personally, I have even experienced one in the, okay, Maori, I'll be with you shortly. I opened one of my first consultancy accounts. And then, of course, being a small business, I had made some money from a project I did. So let's say I did a business plan, a strategic plan, and then I put the money in the bank account. And then obviously I opened an SME account, believing that that is what I should open anyway at the time. And then the charges that hit the bank account, in a few months, the bank had cleaned the small money I had made from my first set of consulting assignments. Now, of course, that is going to make me change my mind if that's one of the very first bank accounts I should ever open. So you realize that then somebody does business and would rather prefer to keep the money under their pillow, because then the raw value is there, no charges on the account. So yes, you're right in saying that is one of the ways to foster financial inclusion. So now people can save, knowing that no charges and fees will be cleaning out the very little savings that they've been able to put on. Then I had Mauli raising the hand. What do you want to say, Mauli? You can unmute and speak. Yeah, Mauli first and then Isaac. Mauli, you can unmute and speak. Or has he dropped off the class? Okay, Isaac, you speak whilst we wait for Mauli to come back.
Okay, thank you very much, madam. Okay, I think there is also the problem of, let's say, the revenue target, or let's say the revenue generation in terms of the poor people. I want to cite an example. Okay. I think formerly, that or the initial requirement was even making it unattractive for even the middle class. So yes. I think so they got to a time that banks that were later coming in were even opening zero balance accounts, because they looked at the revenue coming from the transactions. Okay, because if the person is able to open the bank account, he will transfer money. That's where we are going to get the money.
Where's your capital letters?
And then also, I want to take the telco. The telco also from the beginning also took the chance that I think somebody is making a background. Okay. Okay, so the telco, so the telco also took their revenue from the sale of SIMs, such that the SIMs were being charged for about 100 cedis as at that time, which would be 1 million. But then when MTN started coming in, they changed the revenue stream to the charges they make on calls. So I think with this with this point, with the microfinance, or even with the bank, let's say with the bank, in order for them to serve the poor people, I think they should change their revenue stream from the high interest they charge to maybe as you are saying, maybe as the poor people keep withdrawing and depositing, you also take the charges from them. Okay, so if his business is able to stand out, and then he's able to transfer money, buy more products, I say, purchase more of the pure water, and then saves and then withdraws. And then you take that charge, it will be equivalent as charging the huge amount they did, because now the telcos are also making money even at selling the chips for 2 cedis. And then the banks are also making money even at opening accounts less than 10. I think that's the submission I want to make. Okay.
Okay. That's nice, yes. So indeed, the whole idea is to come up with innovative ways of allowing. So yes, the competition in a sense also help to foster the inclusion of the poor people within the financial services space. So yes, as the days go by, we'll come up, and you are the next generation thinkers who will come up with ideas and deals on how we can serve the poor better and make sure that maybe by the time now we are in 2021, so like now there's what 2030 agenda, we're going to have maybe 98% inclusion. Currently, I think we are still less than, we are just about 50, even on some areas, not on every front. So it's not holistic financial inclusion. Some people have bank accounts, but they never use them. So when you measure inclusion by bank accounts, we seem to be doing well. But when it comes to even having access to credit, which is also another component for financial inclusion, is very negligible. So you're so right in saying that yes, the coming into the opening of accounts with zero balances, etc., is a way to go. And so then the next question is how to make sure that yes, it costs money for the bank to facilitate the opening of the bank accounts, even in terms of the paperwork and etc. So now you find that in some cases you will open the bank account online and only go into the banking hall to validate the rest of the transaction so that it becomes paperless, which then allows and minimizes all the extra paper, the prints and the inks and the whatnot. So once everything can go electronic completely, so that you open the details, fill in the details online, then now just walk into the banking hall, sign an electronic signature, it gets onto the portal, a picture is taken, also electronic, it fused in there, and then that becomes it. And then you have your bank account set up, and then you can make transfers across networks without necessarily using paper. Then, of course, that comes down to a lot of what? Reduction in cost. And so, yes, we will get there someday soon. I think Maoli is still not back, but I think I would want to end the session for today on this one. And then we'll continue. Okay, Isaac, your hand is up.
Yeah, madam, I wanted to add another one, but I forgot.
Sure.
I was that okay. You see, with the mobile, even the quick loan with the mobile phone or the mobile money,
Yes.
what they do is they track your transaction. Okay.
Yes.
So let's say you are able to receive 50 cedis monthly. So for the whole year, so they are able to measure your financial strength
Yeah.
And then based on that, within 50 cities a month for the whole year is about 600 cities.
Yes.
So, or we are able to give you a loan that will last the whole year, which is equivalent to the amount of money you receive. So in this case, you don't give the poor people amount based on what they say. You monitor their revenue stream. So for example, he makes maybe 550 CDs, or let's say he sells pure water and makes 50 CDs per week. So that would be 200 CDs per month. So maybe in 5 months, he's able to make roughly 1,000. So therefore, he can manage a loan facility of 1,000 CDs in 6 months,
Yeah.
rather than listening to a woman who is saying, I want to 2,000.
Yeah.
You see, so in that case, even when he's done, you can also continue the loan and then he will be fine. Okay, that's just what I want.
Very brilliant, very brilliant. So in actual fact, I guess we recently did a consultancy for one institution where we're seeking to develop financial products for the poor, mostly women-led SMEs and the youth-led SMEs. And these things came out. How to go beyond the formal credit assessment. You know, when you go to the banks, they normally will, bring your pay slip and what. These people don't have pay slips. So like you rightly said, we are beginning to look at systems that will go and look at how much credit you even load per month. And then looking at certain proxies that can be said, okay, if somebody buys 5 CDs credits per month, it means that maybe their salary or their income is around 120 CDs maximum per month, because they're usually proxies about how much money people spend in certain areas. You can have a bit of a proxy for safe. And so that becomes an extension. And then you can also now move into some kind of psychometric measurements for even credit risk analysis, where it's more of a questionnaire and it's more for psychoanalytics. So they put in certain questions, and then depending on your responses to those questions, they can actually say that, okay, this is good for this person. And like you rightly said, you understand the borrowing needs and then you give them what they need, not what they necessarily say they want. And that is where the balance will be achieved, because if you give them what they think they want without doing proper assessment, you might very well end up giving them loans that they cannot pay. Okay, now before I end my session, can we spend the next 2 minutes maximum? So it's two. After 2 minutes, when I save, I'm working out. So type your name and your ID number, and let me save up. The time begins to read now. Thirty seconds more. So in a short while, The one with the name Mototima Willie Melchizedek. Your name is reading Ajima Aram Courage, yet the name that is signed into class is different. I want to believe I indicated that I would appreciate if you're signing into class, sign in with your ID number. So this is the last time I'm going to say that if I check and your name does not tally with the name that you put down, I'll take you out. It means you are not in my class. So next time, sign in. Sign in with your name. So your name should show exactly. It should not be showing something else, and then you'll be writing a different name. The name that you log in with should be the same name I see when you type in your full details. Okay. All right. So we meet next week, Wednesday, 4:30 p.m. Enjoy the rest of your evening. Bye-bye.
Bye, madam.
Thank you.
You're welcome.
Au revoir.
Au revoir.
Have
Hello,
a
madam.
nice day.
Yes.
Please, did you give any assignment?
And today, no.
Oh, okay. Thanks.
All right.